Trump, if the government debt is going to double again under Trump, the only way that can happen without significant interest rate increases is that the Fed will buy again US Treasury bonds. In other words, QE4 is almost guaranteed.
Welcome to Rethinking the Dollar. Today I'm excited to have my guest, Dr. Marc Faber, the editor and publisher of the GloomBoomDoom report. Dr. Faber is a well-known economist as well as market forecaster. Today he's going to join us to share his thoughts on the economy as well as those thoughts surrounding the Federal Reserve note, aka the dollar. So Dr. Faber, thank you for taking time to sit down with us at Rethinking the Dollar.
Thank you.
And so
I think about the dollar.
So the first question, we can get right into the questions right away. The first question is, what comes to mind when Dr. Marc Faber hears the words rethinking the dollar?
Well, basically, my view is that the dollar has been very strong and in the process has become overvalued against many other currencies. I'll give you an example. I was recently in Mexico, and we were not in Mexico City, where the price level is probably higher. We were in a city called Chihuahua, which is about 2 hours from the US border. It's bordering New Mexico and Texas. And the price level there was, compared to, say, the US, incredibly low. And then I was in Britain, and granted, my view was always in the last few years that the pound sterling was overvalued. But following its decline after Brexit, I could buy at the bar in a luxury hotel a beer at, say, a 30% discount to a beer in New York City, Los Angeles, San Francisco, Seattle in a luxury hotel.
Right.
So I think that overall the dollar has been on a tear, has been very strong, and now my suspicion is that the dollar will weaken.
Right. And so by the dollar weakening, in your opinion, do you think it's important for citizens worldwide to begin taking interest in matters relevant to the dollar?
Well, I think that the weakness of the dollar may be moderately favorable for commodity prices, for emerging markets. And obviously, if you have a dollar weakness, then I think that emerging markets and Europe in dollar terms would outperform the US stock market. So my view would be, don't worry too much about the dollar weakening, but worry about the investment implications, which are you should be essentially out of US dollars and into other assets in foreign countries.
Right. So let me ask you a question, Dr. Faber. It's 2017. We're in the second month of the year. There's a lot of things happening globally. What are some things that kind of have you alarmed or concerned, or where are you keeping your eye at for investment sake or protection sake, or give us a look into your world?
Well, I'm not usually alarmed because I'm diversified. I have some of my money in precious metals and some in bonds and cash and some in equities and some in real estate. So that all of them would go down is not highly likely, but it's possible. And this is a report I recently wrote in the GloomBoomDoom report, that the big surprise, as you know, at the end of every year and beginning of the new year, everybody has a theme of big surprises for the coming year. And I think the big surprise for investors could be that for once, assets are not desirable. In other words, we have a bull market. We had a bull market in stocks since August 82 in the world, and in bonds since 1981. And during that period of time, we had essentially a period of still consumer price increases, but basically we had a disinflationary environment, maybe not as strongly disinflationary as the central banks would like you to believe. But basically we had nirvana, we have had heavenly conditions for assets. Anyone who owned assets in 1980, by today, he's made a lot of money, either art or collectibles or stocks or bonds or whatever that may have been. And I think this asset inflation is now gradually coming to an end. We see a lot of cracks. Emerging markets have grossly underperformed since 2011, as you know. They've been going down in some cases massively. Luxury real estate is frequently down nowadays, not everywhere and not every house, but by and large, if you look at, say, the Hamptons and also at properties that are for sale in high-end areas around the country, then I would say that these high-end prices have eased in some cases by 30%. And high-end condos in locations like San Francisco, New York, and so forth have also eased, have come down in price. And some stocks have continued to increase in value in the US and driven the indices, the Dow and the S&P higher. But the majority of shares is not performing. The last few days, we were essentially at all-time highs in the market, and on the New York Stock Exchange, there were every day maximum 140 new highs. So on a 12-month basis. So it's not that every stock has been moving up.
Right.
On the contrary.
Now, let me ask you a question. I'm sorry, let me ask you a question now. There's been highs, there's been consecutive highs. Is it because the economy, I mean, quote unquote, is doing so well, or where are these highs coming from? Is it, a lot of people say it's central bank induced, or why are there so many highs, and is the economy is really as good as people say that it is?
Well, first of all, people always say this is happening because of such and such, and that is happening because of something else, and so forth. The reality is that markets move quite independently from news. But I would imagine that one of the reasons for the new high in stocks is that people are optimistic that Trump or President Trump will reduce regulation, that he will implement pro-growth policies, and that he will boost economic activity through infrastructure expenditures and so forth. Now, this is not necessarily my view, but I'm just saying what other fund managers perceive or investors may perceive, maybe wrongly, as I think. But there is another reason. The US stopped QE programs now close to 2 years ago. But the Bank of Japan, the Bank of England, and the ECB have continued to print money. So what happens if the ECB, say, Europe prints money? Then the euro weakens. Then every investor in Europe knows if the euro weakens, then we have to invest in US dollars. So they pile into US dollars. Then they look at the bond yield in the US. They think it's very low. They think that bonds are trash, that they will not yield them sufficiently, which is on a 10 years basis probably true. You get a yield now on the 10 years treasury note of 2.4%. That is not a very high return. That's the maximum you can earn if you hold it to maturity is a 2.4%. So then the alternatives to buy real estate and stocks. Real estate is cumbersome to buy and to sell. It takes months and months to do the transaction. Stocks, you press a button, you buy 1,000 IBM or Microsoft or whatnot, and then 3 days later you press another button and you sell it. So it's convenience.
Yeah.
So what I want to say is the Fed by coordinating monetary policies with foreign central banks, can actually boost asset inflation in the US, because the Japanese, if they see the yen weakening, then they buy US assets and then they also go up. Now, the thing about this is that Mr. Trump, and what he says about that probably comes from the US Treasury Department, is that the euro is artificially weak. In other words, he will not support the policies of Mario Draghi, which is to continue these asset purchases. And now, if these asset purchases in Europe stop and the euro starts to strengthen, then the capital will flow back into euros. The euro will go up, possibly, say, easily by 10-15%. The same for the yen. So you understand, the markets are basically manipulated largely by central banks, and that's why it's very difficult to make predictions. But my sense is that the market recently has been going up. And by the way, the Trump policies in principle are not particularly positive for emerging markets. But which markets have gone up the most this year? Not the US market. The S&P is up 2%. Singapore is up 9%. Hong Kong, 8%. All the Asian markets are up 6%. So you explain to me why the emerging markets are going up when the policies that are proposed by Trump are not particularly positive.
Yeah.
So, I'm telling you, the markets seldom make sense. Now, of course, because I'm involved in financial markets, people always ask me why this and why that. But effectively, frequently, the markets move, and only much later will you know why they move.
Right. Now, let me get your thoughts on, like, you mentioned President Trump and people, the expectations around the things he might end up doing. Now, let me talk about our national debt. We're approaching 20 trillion here in the U.S. How does all that? How does all that?
Higher already.
I'm sorry.
Much higher.
Now, how does?
Higher already.
Okay, so he says much higher already. So how does all that? How will all that debt play into his policy making? I mean, he's going to add to the debt, and our creditors eventually is going to say enough's enough. And then, how does that play on the dollar?
Don't you worry. Mr. Trump has never been shy about debt.
Yeah.
He's borrowed a lot of money, and on 3 occasions his companies were related to him, where he was the sponsor, went bankrupt, and the bondholders all lost their money.
Yeah.
So don't worry about that. The debt is going to be a huge problem. Mm-hmm. And people talk about the so-called economists and experts. They say, why is growth so sluggish in the world, and why do we not get more tractions despite having this massive? The balance sheet of central banks has increased 16 times since 1998. Despite these huge deficits and despite this huge monetary easing, why does the economy not boom? Well, very simply because the debt level is so high. It's a huge difference whether you have a system or a company. Say your company doesn't have any debts and my company has a lot of debts. Now, in order to compete, we have to buy new machinery. With no debts, you can buy these machines, no problem. But that is over indebted to buy these machines is maybe problematic. And so there are lots of things, the economy is like a moving machine. Mm-hmm. It's not a machine per se, because it continuously, the wheels change. Mm-hmm. But the issue really is that as the debt continues to grow, and people say, the deficit came down under Obama. This is all nonsense. The true deficit is the annual increase in the government debt. That is the true deficit.
Mm-hmm.
And under Obama, the government debt has almost doubled.
Yeah.
Almost doubled.
Yeah. People seem to ignore that.
Under Trump, if the government debt is going to double again under Trump, the only way that can happen without significant interest rate increases is that the Fed will buy again US Treasury bonds. In other words, QE4 is almost guaranteed.
Wow. So QE4 is almost guaranteed now. So that means basically the expected, suppose 3 hikes that we're expecting this year won't happen. So do you ever see like a negative territory type of thing, or how will they roll out a QE4 in your estimate?
They can give it another name. They can say helicopter money and this, that. But I think there may be another rate increase. That is a possibility. But again, that the Fed always says we're data dependent. That will depend on the position of the US dollar. It will also depend on the economy. If you truly analyze the economic statistics, then it would suggest that actually the US economy is hardly growing at the present time.
Right. I know towards the end of the year. Yeah. I'm sorry. Go ahead.
If you look at the quality of employment, at retail sales, at say today the statistic about gasoline sales came out, all down. Durable good orders are not performing well. So I think the Fed, they had the opportunity actually now, a week ago, to increase rates and do it.
Right.
So I think maybe one more rate increase and then the economy will be slowing down considerably. And then we have probably no more rate increases. And concerning QE4, they can just start buying assets again. You know, if the deficit goes up or if interest rates go up too much, they can do anything. You know, people say, well, the central banks are out of bullet. Well, they bought so many assets, they can continue buying them. They can buy essentially the whole bond market. They can own the government debt entirely. It's possible. It's not what I would advise to do, but it's possible. Then they can proceed and buy the entire share market. And they can buy all the properties, the real estate, all of it. And then we have state ownership like under communist regimes or under essentially fascist regimes or socialism.
That's not a good thing. Not at all. That's not good.
It's that is maybe what people want, you know.
Yeah. Now, as we draw towards the end of our conversation, some people say that we are in or approaching a recession. Now, if we are, you know, in a recession, or if the data comes out that we are, a lot of things lines up to show that we are, you know, so that will actually kind of speed up that possible QE4, and then how will that impact Trump's plans on his infrastructure building? And because a lot of that stuff's tied in, it's all tied in one way or another. And my only it comes back to hurt the average citizen such as myself.
Well, for sure, the moment it's more obvious, and maybe the Fed knows, but they don't tell you, because all these agencies and all the government, they're a bunch of liars. They will never tell you the truth. So when it becomes, he will not want to have a recession, so he will launch all kinds of, nothing is good. Wherever you look in the world, there are problems. Well, basically, I have 2 reports. One is a printed report that is sent out by mail that goes mainly to either financial institutions or wealthy individuals, that deals more with kind of strategies, you know, about currencies, about whether you should invest in precious metals or real estate or stocks. And if you choose, say, equities, where in equities in the US or in Europe or in Asia and so forth. And That is essentially a slightly unusual report in the sense that we frequently advise to purchase neglected assets. And as you know, the definition of a neglected asset is an asset that is inexpensive in price because nobody shows any interest. The moment investors show great interest in a sector or in a market or in a stock, then obviously it is expensive. Like Valiant was expensive a year ago. It's now 10% of its former value. But that was, since you talk about millennials, that was one of the favorite stocks of millennials. That was one of the highest trading stocks of millennials. Or you talk about Amazon, everybody owns Amazon nowadays and so forth. And these are not neglected investments already. Their performance has already been good. They may still go higher, but the gravy is probably over. Neglected assets are such as, say, Turkey nowadays, or Brazil was a year ago a neglected asset. Russia was a year ago a neglected asset. Today, maybe Mexico. Mexican properties are neglected. Countryside properties in Europe, Portugal, Spain, Italy are all terribly depressed, certainly compared to the major cities. So they are still, in every time, people say it's so complex nowadays. It's the perception about the world that changes. So people say today is very complicated because of this and that and that. And at other times, they don't perceive the world to be complex, but it is the same world.
Yeah.
It turns around the sun and it rotates and it has day and night. It's always about the same, but the climate, the mood of people obviously changes. And the mood today is one where people feel uncertain about the future.
All right. Now, let me ask you a question. Two last questions, since I have you here. What's your thoughts on the long-term importance of having precious metals? And then to wrap it up, the last question, where do you see the Federal Reserve note, as far as it being used domestically in the United States, as well as it being the reserve currency 2, 5, 10 years from now? So those two questions, and I'll let you go.
Well, I don't believe that precious metals or commodities are the optimal investment. Although I know some people that have become very rich by investing in commodities, especially in mining companies, because they were early. They were people that bought, as I just mentioned, distressed assets in countries like Mongolia, or in Labrador, or in Mexico, or in the Democratic Republic of the Congo. There you could buy entire concessions at low prices, but there are high risks involved, and to develop a mine is incredibly difficult. I mean, I always say you have to be kind of a masochist to go into the mining business. But in general, over the longer time, over the last 100 years for sure, if you were in, say, US equities and you continuously reinvested the dividends, you outperformed both bonds and commodities and precious metals. Having said that, there are times when precious metals are incredibly inexpensive compared to financial assets. Such a time was in 1970 or in the late 60s. And subsequently in the 70s, the price of gold went up more than 20 times. 20.
Right.
And the gold price became again very depressed in 1999 compared to financial assets. And since then, from the bottom to the peak, it was up something like six times. And then now it's corrected, but it's still up substantially and has still outperformed the stock market dramatically since 1999. But as an example, last year, at the end of 2015, the gold shares became very cheap. Barrick was at less than $6, Freeport at less than $6, and you could buy secondary mines at very distressed prices. And since then, many mining stocks are up 3 times, 4 times. And last year, that the financial people don't want to tell you. They only want to talk about Tesla and Google and Amazon and so forth.
Facebook.
But last year, the fact is, gold shares significantly outperformed the broader market. Significantly. Lots of gold shares doubled. The GDX was up something like 60%. And even this year, nobody talks about this. All they talk about is Trump and how great it's for the US economy. But Philadelphia gold index is up 22% year to date in 1 month, in other words.
Really?
That they don't talk about.
Something to look into.
If you really
yeah, something to look into, for real. But no, so as we draw towards the end, give us your thoughts long term of the Federal Reserve note. The show is called Rethinking the Dollar. My goal is to inform people about the importance of keeping an eye on our national currency. Give us your thoughts on it being used, as a global reserve currency for years to come, or is that coming to an end, or can you see a transition anytime in our lifetime?
Well, to answer this question would require quite some time. But what I want to say and emphasize, the US position relative to the rest of the world today is not the same as the US position economically, military, and geopolitically it was in 1950 to 1960. The US relative to the rest of the world has been shrinking. It's not that the US as an economy has been shrinking, but relative to the rest of the world. And each empire eventually suffers under its own weight because the expenditures are too big. And we just wasted something like $15 trillion in Afghanistan, in Iraq, in the Middle East, and on social programs in the US. You understand? The
right.
Government debt in 1995 was still just $4 trillion. We're now at 20. And we are not counting here the unfunded liabilities. In 1980, the government debt was $1 trillion. So we've gone up 20 times since 1980 on the government debt. And we have also in the 70s, there were hardly any unfunded liabilities. Today, the unfunded liabilities are gigantic, and actually they keep on going up because the returns for pension funds have been relatively muted. Mm-hmm. So we are facing a lot of problems. And, the fact is they are now, and I've written about this for a long time, and I've spoken at conferences about this subject. When I started to work in 1970, to be precise, I started on Wall Street, although I'm Swiss. At the time, for young people in Europe and the US, it was easy to get a job, and there wasn't that much competition. And relative to the prices of assets, real estate, stocks, bonds, the wages were high. Now the millennials, there are studies, 50% of millennials earn less than their parents.
Right.
Yeah. So we have a first generation of people whose great expectations will be badly disappointed. Badly.
Yeah, I do agree. Well, Dr. Faber, thank you for taking time to sit down with us and Rethinking the Dollar. Definitely enjoy having a conversation with you. I learned a lot, as always. And continue to do a great job at what you do, informing the world and keeping us up to date. So keep doing what you're doing. Thank you for taking time, and you enjoy the rest of your night.